Welcome to Birdsey. In this video, we'll work through exam-style questions, show you what the exam is really testing, and give you clear takeaways to get you ready for exam day. Let's get started.
Let's start with a review of federal mortgage-related laws. Which of the following fees must be included in the calculation of the finance charge under the Truth in Lending Act for a closed-end mortgage loan? Is it A, title insurance premium, B, appraisal fee paid to a third party, C, prepaid interest, or D, escrow deposit for property taxes? The correct answer is C, prepaid interest. Why exam takers miss this? Many confuse which fees are always included in the finance charge. Only fees directly related to the extension of credit, such as prepaid interest, are always included, while others like title insurance and appraisal fees are excluded unless paid to the creditor as a condition of the loan. If a lender fails to provide the required Truth in Lending Act disclosures before consummation of a closed-end loan, which of the following is the most accurate consequence under TILA? Is it A, the loan is automatically void, B, the borrower may have a right to rescind the transaction, C, the lender must refund all interest paid, or D, the loan must be re-underwritten? The correct answer is B, the borrower may have a right to rescind the transaction. Why this is hard? Many assume the loan is automatically void or unenforceable, but TILA generally provides for civil liability, rescission rights, or regulatory penalties rather than automatic voiding of the contract. A borrower receives a loan estimate under the Truth in Lending Act, but the lender later discovers an error in the disclosed APR that is less than 1/8 of 1% off. What is the lender's obligation regarding redisclosure? Is it A, no redisclosure is required because the error is within the allowable tolerance, B, the lender must issue a corrected loan estimate immediately, C, the loan must be canceled and re-originated, or D, the borrower must be notified in writing, but no new disclosure is required? The correct answer is A, no redisclosure is required because the error is within the allowable tolerance. Why this trips people up? Many believe any APR error requires redisclosure, but TILA allows a tolerance for minor errors. Only errors exceeding the tolerance threshold require a corrected disclosure. Real Estate Settlement Procedures Act, Definitions and Requirements. Under the Real Estate Settlement Procedures Act, which of the following transactions is not covered by RESPA requirements? Is it A, a loan to purchase a single-family home using a federally insured lender, B, a refinance of a residential mortgage by a federally regulated lender, C, a temporary construction loan for a new home, or D, a loan secured by a first lien on a condominium unit? The correct answer is C, a temporary construction loan for a new home. Why this trips people up? Many test takers assume all real estate transactions are covered, but RESPA specifically excludes certain types, such as temporary financing like construction loans. The other options are covered because they involve federally related mortgage loans for residential properties. Which of the following best describes the definition of a thing of value under RESPA as it relates to prohibited kickbacks? Is it A, only cash payments or direct monetary compensation, B, any payment, service, discount, or benefit given in exchange for a referral, C, only gifts or entertainment valued over a certain dollar amount, or D, only tangible items that can be physically transferred? The correct answer is B, any payment, service, discount, or benefit given in exchange for a referral. Why this is hard? The term thing of value is broadly defined under RESPA and includes much more than just cash or direct payments. Many test takers incorrectly limit it to money or tangible gifts, missing that it covers any benefit, including services or discounts.
How'd you do on the first 5 questions? Go ahead and subscribe to Birdsey now and turn your progress into exam day confidence. Ready to jump back in? Let's go.
A mortgage broker refers a client to a title company and receives a discount on personal title insurance premiums as a result. Under RESPA, how is this arrangement classified? Is it A, permissible because the benefit is not monetary? B, permissible because the discount is for personal use? C, not covered by RESPA since it does not involve a direct payment? Or D, a prohibited kickback because any benefit for a referral is illegal under RESPA? The correct answer is D, a prohibited kickback because any benefit for a referral is illegal under RESPA. Why exam takers miss this? Many overlook that RESPA's anti-kickback provisions apply even if the benefit is indirect or personal, not just business-related. The discount is a thing of value and is prohibited if given for a referral. Equal Credit Opportunity Act, terminology and prohibited practices. Which of the following is considered a prohibited basis for credit discrimination under the Equal Credit Opportunity Act, even if the creditor believes it is relevant to creditworthiness? Is it A, applicant's employment status, B, applicant's credit history, applicant's marital status, or D, applicant's income amount? The correct answer is C, applicant's marital status. Why exam takers miss this? Many confuse legitimate underwriting factors with prohibited bases. The ECOA specifically prohibits discrimination based on protected characteristics, even if a creditor thinks it affects risk. Marital status is a protected class, while income source, credit history, and employment status may be considered if applied consistently. A creditor asks an applicant about their spouse's financial information, even though the applicant is applying for individual credit and does not live in a community property state. Under ECOA, is this permissible? Is it A, yes, because the creditor may always request spousal information? B, no, unless the spouse is a co-applicant where the applicant resides in a community property state? C, yes, if the applicant is married, regardless of state law? Or D, no, unless the applicant is under 21 years old? The correct answer is B, no, unless the spouse is a co-applicant or the applicant resides in a community property state. Why this is hard? Many assume spousal information is always relevant, but ECOA restricts such inquiries unless the spouse is involved in the transaction or the applicant lives in a community property state. This trips up test takers who overgeneralize spousal financial relevance. If a creditor refuses to consider income from alimony or child support when evaluating an applicant's ability to repay, which ECOA principle is being violated? Is it A, discrimination based on source of income, B, discrimination based on marital status, C, discrimination based on age, or D, discrimination based on national origin? The correct answer is A, discrimination based on source of income. Why this trips people up? Many believe creditors can exclude certain income sources, but ECOA requires that all sources of income, including alimony and child support, be considered if the applicant chooses to disclose them. Excluding them is a prohibited practice. Fair Housing Act, protected classes and definitions. Which of the following is not considered a protected class under the Federal Fair Housing Act, even though it is sometimes mistakenly believed to be covered? Is it A, marital status, B, national origin, C, religion, or D, familial status? The correct answer is A, marital status. Why this trips people up? Many test takers assume marital status is protected because it is covered by some state laws, but it is not a Federal Fair Housing Act protected class. The other options are all federally protected classes, so careful reading and knowledge of federal versus state coverage is required.
If you want more than just rapid-fire questions, head over to birdsey.ai. You can take unlimited practice exams and get instant help from your personal AI study partner. It's like having a tutor 24/7. Try it free. You'll find a link in the description.
A landlord refuses to rent to a single parent with 2 children, citing a policy of no children allowed. Which protected class is most directly implicated by this action under the Fair Housing Act? Is it A, sex, B, familial status, C, disability, or D, race? The correct answer is B, familial status. Why exam takers miss this? Many confuse familial status with sex or disability protections. The correct answer is familial status, which specifically covers households with children under 18. The other options are not directly implicated by this scenario. A real estate agent tells a client that a certain neighborhood is not suitable for families with children due to its demographics. Which Fair Housing Act protected class is most likely being violated by this statement? Is it A, race, B, national origin, C, familial status, or D, religion? The correct answer is C, familial status. Why this is hard? The phrase targets families with children, which is covered by familial status, but many confuse this with race or national origin due to the mention of demographics. Only familial status is directly implicated by discouraging families with children. Home Mortgage Disclosure Act, terminology, and reporting concepts. Which of the following transactions is not required to be reported under the Home Mortgage Disclosure Act when completed by a depository institution subject to HMDA reporting requirements? Is it A, a home purchase loan origination, B, a loan assumption where the lender approves the new borrower, C, a purchase of a closed-end mortgage loan from another lender on the secondary market, or D, a refinancing of a dwelling secured loan? The correct answer is C, a purchase of a closed-end mortgage loan from another lender on the secondary market. Why this trips people up? Many assume all mortgage-related transactions must be reported, but HMDA specifically excludes certain types, such as the purchase of a loan on the secondary market. This distinction is subtle, and test takers often confuse secondary market purchases with originations or assumptions, which are reportable. When reporting the property location for a multifamily dwelling loan under HMDA, which location must be used if the loan is secured by multiple properties in different census tracts? Is it A, the property where the borrower resides, B, the property securing the largest portion of the loan amount, C, the property with the highest appraised value, or D, the property listed first on the security instrument regardless of loan amount? The correct answer is B, the property securing the largest portion of the loan amount. Why exam takers miss this? Many assume the location of the primary property or the borrower's residence should be used, but HMDA requires reporting the location of the property with the greatest loan amount, or if equal, the property listed first. This subtlety is often overlooked. A lender receives a pre-approval request for a home purchase loan, issues a written pre-approval, but the applicant never submits a formal application. How should this be reported under HMDA? Is it A, report as a denied pre-approval request, B, report as an approved but not accepted application, C, report as a withdrawn application, or D, do not report the pre-approval request? The correct answer is D, do not report the pre-approval request. Why this is hard? Many believe any pre-approval activity must be reported, but HMDA only requires reporting pre-approvals that result in an application or a credit decision. If the applicant never applies, no action is reported, which is a subtle but critical distinction. Secure and fair enforcement for Mortgage Licensing Act definitions. Under the Secure and Fair Enforcement for Mortgage Licensing Act, which of the following individuals is not considered a mortgage loan originator? Is it A, an individual who takes residential mortgage loan applications? B, an individual who offers or negotiates terms of a residential mortgage loan for compensation? C, an individual who performs only administrative or clerical tasks on behalf of a licensed originator? Or D, an individual who is compensated for referring a borrower to a licensed originator? The correct answer is C, an individual who performs only administrative or clerical tasks on behalf of a licensed originator. Why this trips people up? Many assume anyone involved in mortgage transactions is a mortgage loan originator, but the Act specifically excludes individuals who only perform administrative or clerical tasks. This distinction is often overlooked, especially when the person's job title sounds similar to a loan originator. Which of the following best describes the distinction between a registered mortgage loan originator and a state-licensed mortgage loan originator under the SAFE Act? Is it A, both are required to obtain state licenses and register with the NMLS? B, registered originators are employees of federally regulated institutions, while state-licensed originators are not? C, registered originators are not subject to background checks, while state-licensed originators are? Or D, state-licensed originators do not need to register with the NMLS? The correct answer is B. Registered originators are employees of federally regulated institutions, while state-licensed originators are not. Why this is hard? The terms are similar and both require registration with the NMLS, but only state-licensed originators are subject to state licensing requirements. Many confuse federal registration with state licensure. A bank employee who only provides general information about loan products but never takes applications or negotiates terms is asked if they must be licensed as a mortgage loan originator under the SAFE Act. What is the correct answer? Is it A, no, because providing general information does not meet the definition of a mortgage loan originator? B, yes, because discussing loan products with consumers requires licensing? C, yes, unless the employee is supervised by a licensed originator? Or E, no, but only if the employee works for a non-depository institution? The correct answer is A, no, because providing general information does not meet the definition of a mortgage loan originator. Why exam takers miss this? The SAFE Act's definition hinges on taking applications or negotiating terms, not merely discussing products. Many mistakenly believe any discussion of loan products triggers licensing, but general information alone does not. Fair Credit Reporting Act terminology and consumer rights. Under the Fair Credit Reporting Act, which of the following best describes the consumer's right to dispute inaccurate information on their credit report? Is it A, the consumer must provide documentary proof before the Bureau investigates? B, the consumer can only dispute information with the creditor, not the Bureau? C, the consumer may notify the Credit Bureau, which must investigate and correct or delete inaccurate information? Or D, the consumer must wait for the Bureau to contact them about inaccuracies? The correct answer is C, the consumer may notify the Credit Bureau, which must investigate and correct or delete inaccurate information. Why this is hard? Many confuse the process or believe the consumer must prove the inaccuracy. In reality, the consumer only needs to notify the Credit Bureau, which must then investigate. Some options describe related rights, but not the specific dispute process, leading to confusion. Which of the following best distinguishes a consumer reporting agency from a furnisher of information under the Fair Credit Reporting Act? Is it A, a consumer reporting agency is always a government entity? B, a consumer reporting agency assembles and sells credit reports, while a furnisher provides information to the agency? C. A furnisher is responsible for investigating consumer disputes directly with the consumer. Or D. A consumer reporting agency only collects information from public records. The correct answer is B. A consumer reporting agency assembles and sells credit reports, while a furnisher provides information to the agency. Why exam takers miss this? The terms are often used interchangeably, but the FCRA defines them distinctly. A consumer reporting agency compiles and sells reports, while a furnisher provides data to the agency. Many confuse the direction of information flow. A lender denies a mortgage application based on information from a consumer report, but fails to provide the applicant with an adverse action notice. Which specific consumer right under the Fair Credit Reporting Act has been violated? Is it A, the right to receive an adverse action notice? B, the right to dispute inaccurate information? C, the right to a free annual credit report? Or D, the right to freeze their credit file? The correct answer is A, the right to receive an adverse action notice. Why this trips people up? The FCRA requires a specific adverse action notice, not just a general explanation or access to the report. Many confuse this with the right to a free report or to dispute errors, but the notice is a distinct requirement.
Have you noticed the code in the bottom corner? The next time you're stumped, take that code to birdsey.ai. You'll get immediate help, complimentary study sessions, and access to hundreds of additional questions. It's the best tool to help you pass with confidence.
Gramm-Leach-Bliley Act, privacy terminology. Under the Gramm-Leach-Bliley Act, which of the following best describes the distinction between non-public personal information and publicly available information when determining what must be protected by a financial institution's privacy policy? B. Publicly available information is always protected under the Act, while non-public personal information is not. C. Non-public personal information is any personally identifiable data provided by a consumer that is not publicly available, while publicly available information is excluded from privacy protections. Or D. Both non-public personal information and publicly available information are treated the same under the Act. The correct answer is C. Non-public personal information is any personally identifiable data provided by a consumer that is not publicly available, while publicly available information is excluded from privacy protections. Why this trips people up? Many confuse information obtained from public sources with information that is not protected. The correct answer highlights that non-public personal information includes data provided by a consumer that is not publicly available, even if some elements are public. A common mistake is to think that any information that could be found publicly is exempt from privacy protections. Which of the following scenarios would not require a financial institution to provide an initial privacy notice under the Gramm-Leach-Bliley Act? Is it A, a consumer opens a deposit account with the institution? B, a consumer purchases a cashier's check in a one-time transaction with no ongoing relationship? Or D, a consumer signs up for online banking services? The correct answer is B, a consumer purchases a cashier's check in a one-time transaction with no ongoing relationship. Why exam takers miss this? Many assume any consumer interaction triggers a privacy notice, but the Act only requires it when a customer relationship is established. A one-time transaction without ongoing relationship does not require the notice, which is a subtle but important distinction. If a financial institution shares customer information with a non-affiliated third party for marketing purposes, under which condition would the Gramm-Leach-Bliley Act not require the institution to provide an opt-out notice to the customer? Is it A, the third party is a service provider that uses the information solely to perform services for the institution? B, the third party is an unaffiliated company using the information for its own marketing? C, the institution sells the information to a non-affiliated marketing firm? Or D, the third party is an affiliate using the information for cross-marketing unrelated products. The correct answer is A. The third party is a service provider that uses the information solely to perform services for the institution. Why this is hard? The Act has specific exceptions to the opt-out requirement, such as sharing information with service providers for processing transactions. Many confuse marketing with all third-party sharing, but if the third party is performing services on behalf of the institution and does not use the information for its own purposes, no opt-out is required. Bank Secrecy Act and anti-money laundering terminology. Which of the following best describes the difference between structuring and layering as stages of money laundering under the Bank Secrecy Act? Is it A. Structuring involves using multiple accounts, while layering involves reporting suspicious activity? B. Structuring is the process of integrating illicit funds, while layering is the initial deposit of those funds? Or D. Structuring and layering are interchangeable terms for the same process? The correct answer is C. Structuring is breaking up transactions to avoid reporting, while layering is moving funds through various transactions to disguise their origin. Why this trips people up? Many confuse structuring with layering because both involve breaking up transactions. Structuring is the act of breaking up large transactions to avoid reporting thresholds, while layering involves moving funds through complex transactions to obscure their origin. The correct answer distinguishes the initial evasion tactic from the subsequent concealment process. A mortgage lender notices a borrower making several cash payments just under the reporting threshold over a short period, and then wiring the funds to a foreign account. Under the Bank Secrecy Act, which activity is most likely to trigger a suspicious activity report? Is it A. The use of a foreign account alone? B. The pattern of multiple cash payments just under the reporting threshold? C. The fact that the borrower is a non-U.S. citizen? Or D. The total amount of funds deposited over time? The correct answer is B. The pattern of multiple cash payments just under the reporting threshold. Why this is hard? Both structuring and international wire transfers can be red flags, but the pattern of multiple cash payments just under the threshold is a classic structuring indicator, which specifically triggers a suspicious activity report under BSA rules. The wire transfer alone may not require a report unless linked to suspicious structuring. Which statement most accurately reflects the Bank Secrecy Act's requirements for identifying beneficial owners of legal entity customers in mortgage transactions? Is it A. Both individuals with significant ownership and those with significant control must be identified? B. Only individuals who own more than a specified percentage of the entity must be identified? C. Only the person opening the account must be identified, regardless of ownership or control? Or D. Identification is required only if the entity is a shell company? The correct answer is A. Both individuals with significant ownership and those with significant control must be identified. Why exam takers miss this? Many believe only direct owners must be identified, but BSA rules require identifying both individuals with significant ownership and those with significant control. The correct answer reflects the dual requirement, while distractors focus on only one aspect or misstate the rule. Do not call and telemarketing terminology. Which of the following situations would not be considered a violation of the National Do Not Call Registry rules for mortgage telemarketing calls? Is it A. Calling a consumer on the Do Not Call registry to offer a new mortgage product without prior consent? B. Calling a consumer on the Do Not Call registry after obtaining their number from a purchased lead list? C. Calling a consumer on the Do Not Call registry who completed a mortgage application with your company within the last 18 months? Or D. Calling a consumer on the Do Not Call registry who previously requested not to be called by your company? The correct answer is C. Calling a consumer on the Do Not Call registry who completed a mortgage application with your company within the last 18 months. Why this trips people up? Many assume any unsolicited call to a number on the Do Not Call registry is a violation. But there are exceptions. The correct answer reflects the established business relationship exception, which is often misunderstood or overlooked. Distractors are plausible because they describe common violations or misapply the exception. A mortgage company uses an autodialer to call potential clients with a pre-recorded message about refinancing options. Which statement best describes the legal requirements under federal telemarketing laws for this practice? Is it A, the company may call any consumer not on the Do Not Call registry without prior written consent? B, the company must obtain prior express written consent from the consumer before making such calls? C, the company may call existing customers with pre-recorded messages without any additional consent? Or D, the company can avoid liability by identifying itself at the beginning of the message? The correct answer is B. The company must obtain prior express written consent from the consumer before making such calls. Why exam takers miss this? Many confuse the rules for live calls with those for pre-recorded or auto-dialed calls. The correct answer highlights the stricter consent requirements for pre-recorded messages, which trip up those who assume general telemarketing rules apply equally. General mortgage knowledge, mortgage terminology, and loan component definitions. Which of the following best distinguishes a promissory note from a mortgage in a typical residential loan transaction? Is it A, both documents create the borrower's legal obligation to repay the loan? B, the mortgage specifies the interest rate and repayment schedule? The promissory note is the borrower's promise to pay, while the mortgage secures the property as collateral. Or D, only the mortgage is recorded in the public land records? The correct answer is C. The promissory note is the borrower's promise to pay, while the mortgage secures the property as collateral. Why this is hard? Many confuse the promissory note and the mortgage as interchangeable. But only the note is the borrower's promise to repay, while the mortgage secures the property as collateral. The trap is thinking both documents create the debt, when only the note does. The mortgage enforces repayment by securing the property. In the context of adjustable rate mortgages, which component most directly determines the amount by which the interest rate can change at each adjustment period? Is it A, margin, B, periodic adjustment cap, C, index, or D, initial interest rate? The correct answer is B, periodic adjustment cap. Why exam takers miss this? Many confuse the index, margin, and caps. The index determines the base rate, the margin is added to it, but the periodic adjustment cap specifically limits how much the rate can change at each adjustment, which is often overlooked. A borrower signs a mortgage with a due-on-sale clause and later transfers the property to a relative without lender consent. Which loan component is most directly implicated by this action? Is it A, due-on-sale clause, B, defeasance clause, C, acceleration clause, or D, prepayment penalty? The correct answer is A, due-on-sale clause. Why this trips people up? Many confuse acceleration clauses with due-on-sale clauses. The due-on-sale clause specifically allows the lender to demand full repayment if the property is transferred, while acceleration generally applies to default, not transfer. Conventional loan terminology. Which of the following best describes the difference between a conforming and a non-conforming conventional loan? Is it A, conforming loans are always insured by the government? B, non-conforming loans have lower credit requirements than conforming loans? C, conforming loans meet Fannie Mae and Freddie Mac guidelines, while non-conforming loans do not? Or D, non-conforming loans always have lower interest rates than conforming loans? The correct answer is C. Conforming loans meet Fannie Mae and Freddie Mac guidelines. while non-conforming loans do not. Why exam takers miss this? Many confuse conventional with conforming, but not all conventional loans meet the secondary market standards set by Fannie Mae and Freddie Mac. The key distinction is that conforming loans adhere to these standards, while non-conforming loans do not, often due to loan amount or borrower profile. In the context of conventional loans, which statement about private mortgage insurance, PMI, is most accurate? Is it A, PMI is required on all conventional loans regardless of down payment? B, PMI protects the lender and is usually required when the down payment is less than 20%. C, PMI is a government insurance program for conventional loans. Or D, PMI can only be canceled after the loan is fully paid off. The correct answer is B. PMI protects the lender and is usually required when the down payment is less than 20%. Why this trips people up? Many believe PMI is always required, or that it covers the borrower. The subtlety is that PMI protects the lender and is typically required when the down payment is less than a certain percentage, not in all conventional loans. A borrower applies for a conventional loan that exceeds the maximum loan limit set by Fannie Mae for their county. What is the correct term for this type of loan? Is it A, jumbo, B, subprime, C, Alt A, or D, conforming? The correct answer is A, jumbo. Why this is hard? Many confuse jumbo with non-conforming or subprime. The correct term for a conventional loan exceeding conforming limits is jumbo, which is a subset of non-conforming loans, but not all non-conforming loans are jumbo. Government loan program terminology. Which government loan program specifically requires an upfront mortgage insurance premium that can be financed into the loan amount? Is it A, FHA loan, B, VA loan, C, USDA loan, or D, conventional loan? The correct answer is A, FHA loan. Why this trips people up? FHA loans require an upfront mortgage insurance premium that can be financed, while VA and USDA loans have different funding fee structures. Many confuse the VA funding fee with FHA's MIP, but only FHA calls it an upfront mortgage insurance premium and allows it to be financed in this way. Which of the following statements best distinguishes the VA loan entitlement from the VA loan guarantee? Is it A, entitlement is the amount the VA will pay the lender if the borrower defaults? B, entitlement is the veteran's benefit amount, while guarantee is the amount the VA will pay the lender if the borrower defaults? C, guarantee is the veteran's eligibility, while entitlement is the lender's protection? Or D, both terms refer to the maximum loan amount available to the veteran? The correct answer is B. Entitlement is the veteran's benefit amount, while guarantee is the amount the VA will pay the lender if the borrower defaults. Why exam takers miss this? Many confuse entitlement, the veteran's benefit amount, with guarantee, the amount the VA will pay the lender if the borrower defaults. The terms are often used interchangeably, but only the guarantee protects the lender, while entitlement refers to the veteran's eligibility. A borrower is purchasing a rural property and is told the loan program requires both an upfront and annual guarantee fee, but no down payment. What government loan program is most likely being described? Is it A, FHA loan, B, VA loan, C, USDA loan, or D, conventional loan? The correct answer is C, USDA loan. Why this is hard? USDA loans are the only government program with both an upfront and annual guarantee fee, and no down payment requirement. FHA requires a down payment, and VA has a funding fee, but no annual fee. Many confuse USDA and FHA due to similar terminology. Adjustable rate mortgage terminology. Which feature distinguishes a payment cap from an interest rate cap in an adjustable rate mortgage, particularly in how each affects the loan balance over time? Is it A, a payment cap limits how much the interest rate can increase during an adjustment period? B, an interest rate cap restricts the maximum monthly payment a borrower can be charged? C, a payment cap may result in negative amortization, while an interest rate cap does not directly cause it? Or D, both caps prevent the loan balance from increasing due to unpaid interest? The correct answer is C. A payment cap may result in negative amortization, while an interest rate cap does not directly cause it. Why this is hard? Many confuse payment caps and interest rate caps, assuming both limit borrower risk equally. The correct answer highlights that payment caps can lead to negative amortization, while interest rate caps only limit rate increases. Test takers often miss that payment caps may not prevent the loan balance from growing if interest accrues beyond the capped payment. If an ARM includes a periodic adjustment cap but no lifetime cap, what is the primary risk to the borrower over the life of the loan? Is it A, the interest rate can never increase by more than the periodic cap in any year? B, the interest rate could rise significantly over time since there is no overall limit on increases? C, the initial rate is guaranteed for the entire loan term? Or D, negative amortization is unavoidable with this structure? The correct answer is B. The interest rate could rise significantly over time since there is no overall limit on increases. Why exam takers miss this? Many assume periodic caps provide sufficient protection, overlooking that without a lifetime cap, rates could eventually rise without limit. The best answer focuses on the cumulative risk, not just the risk at each adjustment period. A borrower's ARM has a margin of 2% and is indexed to a benchmark that currently reads 3%. If the loan's interest rate cap is 5%, what is the highest rate that can be charged at the next adjustment? Is it A, 2%, B, 3%, C, 5% plus margin, or D, 5%? The correct answer is D, 5%. Why this trips people up? Many test takers add the margin and index to get 5% and stop there, missing that the cap may restrict the rate, even if the formula would allow more. The correct answer is the lower of the calculated rate or the cap, which is 5% in this case. Reverse mortgage terminology. Which of the following most accurately describes the role of the principal limit in a home equity conversion mortgage reverse mortgage? Is it A, it is the total appraised value of the property? B, it is the maximum loan balance allowed by HUD at closing? C, it is the maximum amount a borrower can initially access, determined by age, interest rate, and property value? Or D, it is the total amount of interest that can accrue over the life of the loan? The correct answer is C. It is the maximum amount a borrower can initially access, determined by age, interest rate, and property value. Why this trips people up? Many confuse the principal limit with the maximum claim amount or loan balance. The principal limit is the maximum amount a borrower can access based on age, interest rate, and property value, not the total loan proceeds or property value. Distractors often mix up these related but distinct terms. In the context of reverse mortgage terminology, what is the key difference between a line of credit payment option and a 10-year payment option under a HECM? Is it A, both options provide fixed monthly payments for a set term? B, the line of credit allows flexible withdrawals and unused funds grow over time, while 10-year provides fixed monthly payments for life? C, 10-year payments can be adjusted at the borrower's request, while line of credit payments cannot? Or D, the line of credit is only available for a limited number of years, while 10-year is available until the loan matures? The correct answer is B. The line of credit allows flexible withdrawals and unused funds grow over time, while 10-year provides fixed monthly payments for life. Why exam takers miss this? Both options provide ongoing access to funds, but the line of credit allows flexible withdrawals and grows if unused, while tenure provides fixed monthly payments for life. Many confuse the growth feature or think both offer the same flexibility. A borrower with a HECM reverse mortgage passes away and the heirs wish to keep the property. Which term best describes the amount the heirs must pay to satisfy the loan and retain ownership? Is it A, loan payoff amount, B, principal limit, C, maximum claim amount, or D, servicing fee set aside? The correct answer is A, loan payoff amount. Why this is hard? Many confuse the maximum claim amount, loan balance, and principal limit. The correct term is loan payoff amount, which is the lesser of the loan balance or the property's appraised value. Exam takers often select related but incorrect terms. Loan to value and equity terminology. When calculating loan-to-value ratio for a cash-out refinance, which property value should be used to determine the maximum loan amount allowed by most lenders under standard guidelines? Is it A, the original purchase price, B, the outstanding loan balance, C, the current appraised value, or D, the sum of original purchase price and cost of improvements? The correct answer is C, the current appraised value. Why exam takers miss this? Many confuse the appraised value with the original purchase price or the outstanding loan balance. The correct answer is the current appraised value, as lenders base LTV on the most recent appraisal, not the original price or loan amount. The distractors reflect common misapplications of the rule. A borrower has a first mortgage and a home equity line of credit, both secured by the same property. When calculating the combined loan-to-value ratio, which amounts must be included in the numerator? Is it A, only the outstanding balance of the first mortgage, B, the outstanding balances of both the first mortgage and the home equity line of credit, C, only the available credit on the home equity line of credit, or D, the original loan amounts of both the first mortgage and the home equity line of credit? The correct answer is B, the outstanding balances of both the first mortgage and the home equity line of credit. Why this is hard? Many test takers forget that combined LTV includes all outstanding balances of loans secured by the property, not just the first mortgage. The correct answer is the sum of both the first mortgage and the home equity line of credit balances. Some confuse this with only the first mortgage or only the available credit. A property was purchased for a lower price than its appraised value due to a distressed sale. For a purchase loan, which value do most lenders use to calculate the loan-to-value ratio, and why might this create confusion? Is it A, the lower of the purchase price or appraised value, B, the appraised value regardless of purchase price, C, the purchase price plus closing costs, or D, the assessed value for property taxes? The correct answer is A, the lower of the purchase price or appraised value. Why this trips people up? Many assume lenders will use the higher appraised value, but most lenders use the lower of the purchase price or appraised value to prevent overlending. The distractors reflect common misunderstandings about which value is used and why. Interest rate and discount point terminology. When a borrower pays discount points to lower the interest rate on a fixed-rate mortgage, which of the following statements best describes the impact on the annual percentage rate APR? Is it A, the APR decreases because the note rate is lower, B, the APR remains unchanged because points are optional, C, the APR increases because discount points are prepaid finance charges, or D, the APR is not affected by discount points on fixed-rate loans? The correct answer is C. The APR increases because discount points are prepaid finance charges. Why exam takers miss this? Many confuse the effect of discount points on the note rate versus the APR. While discount points reduce the note rate, they are prepaid finance charges and increase the APR, not decrease it. Some believe the APR drops because the rate drops, but the APR calculation includes upfront costs. Which of the following best distinguishes a lender credit from a discount point in mortgage transactions? A lender credit lowers the interest rate by increasing closing costs. B. A lender credit reduces closing costs by increasing the interest rate. C. A discount point reduces closing costs by lowering the interest rate. Or D. A discount point increases the interest rate by reducing closing costs. The correct answer is B. A lender credit reduces closing costs by increasing the interest rate. Why this is hard? Lender credits and discount points are often confused because both affect closing costs and interest rates, but in opposite ways. Lender credits reduce upfront costs in exchange for a higher rate, while discount points increase upfront costs for a lower rate. Many test takers reverse these roles. A borrower is quoted a par rate, but chooses to pay discount points to obtain a lower rate. Which of the following is the most accurate statement regarding how this affects the total finance charge disclosed under the Truth in Lending Act, TILA? Is it A, the total finance charge increases because discount points are included as prepaid finance charges? B, the total finance charge decreases because the borrower pays less interest over time? C, the total finance charge remains unchanged because the note rate is lower? Or D, the total finance charge is not affected by discount points if the loan is at par? The correct answer is A, the total finance charge increases because discount points are included as prepaid finance charges. Why this trips people up? Many assume paying points always saves money, but TILA requires all prepaid finance charges, including discount points, to be included in the total finance charge. The upfront payment increases the disclosed finance charge, even if the monthly payment drops. Mortgage insurance terminology. Which of the following best distinguishes private mortgage insurance (PMI) from mortgage insurance provided by government agencies such as the FHA? Is it A, PMI is only required for loans with down payments above 20%? B, government mortgage insurance is always less expensive than PMI? C, PMI is provided by private insurers and protects the lender on conventional loans, while government mortgage insurance is backed by federal agencies for specific loan programs? Or D, both PMI and government mortgage insurance can be canceled automatically after 5 years? The correct answer is C. PMI is provided by private insurers and protects the lender on conventional loans, while government mortgage insurance is backed by federal agencies for specific loan programs. Why this trips people up? Many confuse the source and function of PMI versus government mortgage insurance. PMI is required by conventional lenders to protect themselves, not the borrower, and is provided by private companies, while FHA insurance is government-backed and has different coverage and cancellation rules. When a borrower pays an upfront mortgage insurance premium on an FHA loan, what is the primary purpose of this payment in the context of mortgage insurance terminology? Is it A, it reduces the loan's principal balance? B, it funds the FHA's mutual mortgage insurance pool to protect lenders against borrower default? C, it serves as a prepayment of the first year's property taxes? Or D, it guarantees the borrower can refinance without additional insurance costs? The correct answer is B. It funds the FHA's mutual mortgage insurance pool to protect lenders against borrower default. Why exam takers miss this? Many assume the upfront premium benefits the borrower directly or reduces monthly payments, but it actually funds the FHA's insurance pool to protect the lender, not the borrower, in case of default. A borrower with a conventional loan reaches a loan-to-value ratio of 78% through scheduled payments but has not requested cancellation of private mortgage insurance. According to federal law, what must the lender do regarding PMI? Is it A. Automatically terminate PMI coverage, B. Continue PMI until the borrower submits a written cancellation request, C. Require a new appraisal before considering PMI cancellation, or D. Reduce the PMI premium but not terminate coverage? The correct answer is A. Automatically terminate PMI coverage. Why this is hard? Many confuse borrower-initiated cancellation with automatic termination. Federal law requires lenders to automatically terminate PMI at 78% LTV, even if the borrower does not request it, which is a subtle but critical distinction. Title insurance and escrow terminology. Which of the following best describes the primary difference between a lender's title insurance policy and an owner's title insurance policy in a typical residential real estate transaction? Is it A. Both policies protect the property owner from undisclosed liens? B. Both policies terminate when the property is sold to a new owner? C. The lender's policy protects the lender's interest in the property, while the owner's policy protects the buyer's equity? Or D. Only the owner's policy covers losses due to forged documents in the chain of title? The correct answer is C. The lender's policy protects the lender's interest in the property, while the owner's policy protects the buyer's equity. Why this trips people up? Many confuse the scope of coverage or believe both policies protect the same parties. The lender's policy protects only the lender's interest up to the loan amount, while the owner's policy protects the buyer's equity. Some options sound plausible, but blur this key distinction. In an escrow closing, which of the following statements about the role of the escrow agent is most accurate when a title defect is discovered before closing? Is it A. The escrow agent must resolve the defect before proceeding with closing? B. The escrow agent must notify the parties and await further instructions before proceeding? C. The escrow agent may provide legal advice to the buyer regarding the defect? Or D. The escrow agent should release funds to the seller if the buyer has signed closing documents? The correct answer is B. The escrow agent must notify the parties and await further instructions before proceeding. Why exam takers miss this? Many assume the escrow agent can resolve title defects or advise parties, but the agent's role is neutral and limited to following instructions. The escrow agent cannot unilaterally clear defects or provide legal advice, which is a common misconception tested on exams. A buyer receives a standard owner's title insurance policy at closing, but later discovers an unrecorded easement affecting the property. Which of the following best explains whether the policy will cover the buyer's loss? Is it A. The policy generally excludes coverage for unrecorded easements, so the loss is not covered? B. The policy covers all easements, recorded or unrecorded, discovered after closing? C. The policy covers the loss only if the easement was created after the policy was issued? Or D. The policy will cover the loss if the buyer can prove the seller knew about the easement? The correct answer is A. The policy generally excludes coverage for unrecorded easements, so the loss is not covered. Why this is hard? Many test takers assume all defects are covered, but standard policies typically exclude unrecorded easements. The distinction between recorded and unrecorded matters is a classic exam trap, as is confusing standard with enhanced coverage. Appraisal and property valuation terminology. Which of the following best distinguishes market value from market price in the context of property appraisal terminology? Is it A. Market value is always higher than market price? B. Market price is determined by the appraiser, while market value is set by the buyer and seller? Or D. Market value and market price are always identical in an open market? The correct answer is C. Market value is an appraiser's opinion of value under typical conditions, while market price is the actual amount paid in a transaction. Why exam takers miss this? Many confuse market value and market price as interchangeable. But market value is a theoretical estimate under specific conditions, while market price is the actual transaction amount. A strong test taker might choose an answer that partially describes one, but not the distinction between both terms. When using the sales comparison approach, which adjustment would most likely be made if a comparable property has a feature that the subject property lacks? Is it A, add the value of the feature to the comparable sale price? B, subtract the value of the feature from the comparable sale price? C, add the value of the feature to the subject property's value? Or D, no adjustment is necessary if the feature is minor? The correct answer is B, subtract the value of the feature from the comparable sale price. Why this is hard? Many confuse whether to add or subtract adjustments. The correct approach is to subtract the value of the feature from the comparable sale price to align it with the subject property. Test takers often reverse the adjustment direction, thinking the subject's value should be increased instead. An appraiser is valuing a property with significant functional obsolescence that cannot be economically corrected. Which valuation approach is most likely to yield the most reliable result? Is it A, cost approach, B, income approach, C, gross rent multiplier approach, or D, sales comparison approach? The correct answer is D, sales comparison approach. Why? This trips people up. Many assume the cost approach is best for properties with obsolescence, but if the obsolescence is incurable, the sales comparison approach is more reliable. The cost approach would overstate value by not fully accounting for the loss in utility. Credit report and underwriting terminology. Which of the following best describes the difference between a credit report inquiry classified as hard versus soft in the context of mortgage underwriting? Is it A, both types of inquiries always lower the applicant's credit score? B, soft inquiries are only visible to the applicant, while hard inquiries are hidden from all parties? C, hard inquiries may impact the applicant's credit score, while soft inquiries do not? Or D, soft inquiries are used for loan approval decisions, while hard inquiries are not? The correct answer is C. Hard inquiries may impact the applicant's credit score, while soft inquiries do not. Why this is hard? Many confuse the impact of hard and soft inquiries on credit scores. Only hard inquiries, typically from a lender evaluating a mortgage application, can affect the score, while soft inquiries such as pre-qualification checks do not. Test takers often misapply this distinction or assume both types are treated the same. When evaluating a borrower's credit report, which of the following would most likely require a written explanation from the borrower during underwriting? Is it A, a single late payment from 5 years ago? B, a paid-off collection account from 3 years ago? C, a credit card with a high balance but no missed payments? Or D, a recent bankruptcy discharge within the past year? The correct answer is D, a recent bankruptcy discharge within the past year. Why exam takers miss this? Many assume all negative items require explanations, but underwriters specifically require explanations for recent, major derogatory events, such as a bankruptcy, rather than for every late payment or old collection. If a borrower's credit report shows multiple names and addresses, but the applicant claims to have lived at only one address in the past 7 years, what is the most appropriate underwriting response? Is it A, ignore the discrepancies if the applicant's current address matches the application? B, request documentation or a letter of explanation from the borrower regarding the additional names and addresses? C, approve the loan if the credit score meets guidelines, regardless of address history? Or D, only verify the addresses if the applicant has a thin credit file? The correct answer is B, request documentation or a letter of explanation from the borrower regarding the additional names and addresses. Why this trips people up? Many assume the underwriter should ignore discrepancies if the applicant provides a plausible story. But unexplained aliases or addresses can signal fraud or identity issues and must be clarified with documentation. Closing and settlement terminology. Which of the following best describes the difference between a closing disclosure and a settlement statement in a federally related mortgage transaction? Is it A, both are required for every mortgage transaction? B, the settlement statement is only used for government-backed loans? C, the closing disclosure is required for most consumer mortgages, while the settlement statement is used for exempt or cash transactions? Or D, the closing disclosure is only provided to the seller, not the buyer? The correct answer is C. The closing disclosure is required for most consumer mortgages, while the settlement statement is used for exempt or cash transactions. Why this trips people up? Many confuse the two forms or assume they are interchangeable. The closing disclosure is required by federal law for most consumer mortgages, while the settlement statement is used in certain exempt transactions or cash deals. The distinction is subtle, but crucial for compliance. In a purchase transaction, which party is typically responsible for ensuring that all closing funds are properly dispersed according to the settlement statement? Is it A, the lender, B, the settlement agent, C, the real estate agent, or D, the borrower? The correct answer is B, the settlement agent. Why exam takers miss this? Many assume the lender or real estate agent handles disbursement, but the settlement agent, often a title company or attorney, is legally responsible for following the settlement statement and distributing funds accordingly. A borrower receives a closing disclosure 3 business days before closing, but notices a significant increase in the loan's APR due to a last-minute lender change. What is the required action regarding the closing timeline? Is it A, a new 3 business day waiting period must begin before closing can occur? B, closing can proceed as scheduled if the borrower signs a waiver? C, only a verbal acknowledgement from the borrower is needed to proceed? Or D, no action is required if the borrower is informed of the change? The correct answer is A. A new 3 business day waiting period must begin before closing can occur. Why this is hard? Many overlook that certain changes, like a significant APR increase, trigger a new 3-day waiting period. The exam trap is assuming only the initial disclosure matters, but material changes require redisclosure and a new waiting period. Mortgage loan origination activities. Loan application terminology and required information. Which of the following pieces of information is required to be collected on a standard residential loan application but is not used to determine creditworthiness? Is it A, gross monthly income, B, outstanding debts, C, ethnicity and race, or D, employment history? The correct answer is C, ethnicity and race. Why this trips people up? Many assume that all information collected is used for underwriting, but demographic data, such as race or ethnicity, is required for government monitoring purposes, not for credit decisions. Applicants often confuse required disclosures with underwriting criteria. When completing a uniform residential loan application, which of the following must be disclosed by the applicant, even if it does not directly impact the loan's collateral value? Is it A, estimated property taxes, B, obligations to pay child support, planned home improvements, or D, homeowners association dues? The correct answer is B, obligations to pay child support. Why exam takers miss this? Many focus only on property-related disclosures, but liabilities like child support must be disclosed even if they do not affect the property's value. This trips up those who equate required disclosures with collateral impact. A borrower applying for a mortgage refuses to provide information about their race and ethnicity on the loan application. What is the loan originator required to do in this situation? Is it A, record the information based on visual observation or surname? B, leave the fields blank and submit the application as is? C, reject the application until the applicant provides the information? Or D, submit a written explanation to the regulator? The correct answer is A, record the information based on visual observation or surname. Why this is hard? Many believe the applicant's refusal ends the process, but the originator must attempt to identify race and ethnicity based on visual observation or surname, as required by HMDA. This subtle rule is often overlooked. Income documentation terminology. Which of the following types of income documentation is generally not acceptable for verifying self-employment income when originating a qualified mortgage loan? Is it A, signed federal tax returns for the past 2 years? B, year-to-date profit and loss statement prepared by the borrower? C, bank statements from the business account for the past 12 months? Or D, a letter from a certified public accountant verifying business income? The correct answer is C, bank statements from the business account for the past 12 months. Why exam takers miss this? Many assume that any business-related document is sufficient for self-employment verification. However, only certain documents, such as tax returns and profit and loss statements, are acceptable. Bank statements alone do not provide enough detail about net income, which is a common misconception. When documenting overtime income for a wage earner, which condition must be met for the income to be considered stable and used for qualifying purposes? Is it A, the borrower has received overtime income for at least 1 year and the employer states it is likely to continue? B, the borrower has received overtime income for at least 2 years and the employer states it is likely to continue? C, the borrower has received overtime income for at least 3 months and the employer states it is guaranteed? Or D, the borrower has received overtime income sporadically over the past 2 years with no employer verification? The correct answer is B. The borrower has received overtime income for at least 2 years and the employer states it is likely to continue. Why this trips people up? Many believe that recent overtime is enough, but lenders require a 2-year history to establish stability. A common error is thinking that a year or less of overtime is sufficient if the employer verifies it will continue. A borrower receives child support payments as part of their income. Which documentation approach is required for the lender to include this income in qualifying ratios? Is it A, a copy of the divorce decree showing the child support amount? B, a letter from the payer stating they will continue to make payments? C, bank statements showing 3 months of deposits from the payer? Or D, documentation of at least 6 months of consistent receipt and evidence that payments will continue for at least 3 years? The correct answer is D, documentation of at least 6 months of consistent receipt and evidence that payments will continue for at least 3 years. Why this is hard? Many test takers confuse voluntary payments or recent awards with what is actually required. Lenders must verify a consistent payment history and likelihood of continuance, not just the existence of a court order or recent payments. Asset verification terminology. Which of the following best describes the difference between a verification of deposit, VOD, and a verification of assets, VOA, in the context of mortgage loan origination asset verification terminology? Is it A, a VOD includes all asset types, while a VOA is limited to checking and savings accounts? B, a VOD is limited to deposit accounts, while a VOA can include retirement and investment accounts? C, both VOD and VOA are required for every mortgage loan application? Or D, a VOA is only used when a borrower has insufficient income documentation. The correct answer is B. A VOD is limited to deposit accounts, while a VOA can include retirement and investment accounts. Why this is hard? Many confuse VOD and VOA as interchangeable. But a VOD only confirms balances in deposit accounts, while a VOA encompasses a broader range of assets, including retirement and investment accounts. Exam takers often select VOD as a catch-all, missing the broader scope required for full asset verification. When reviewing a borrower's asset documentation, which of the following would most likely require additional scrutiny under anti-fraud guidelines, even if the account statement appears legitimate? Is it A, a consistent monthly payroll deposit? B, a stable account balance with no recent deposits? C, a recent large deposit with no clear source? Or D, a small recurring transfer from a joint account? The correct answer is C, a recent large deposit with no clear source. Why this trips people up? Many focus on the appearance of the statement that sudden large deposits are a classic red flag for undisclosed borrowed funds or gifts. Even if the statement looks authentic, unexplained large deposits must be sourced to comply with anti-fraud and underwriting standards. A borrower submits a retirement account statement as proof of assets, but the statement shows a significant penalty for early withdrawal. Which of the following best describes how this asset should be treated in the underwriting process? Is it A, only the net amount available after penalties and taxes is considered as liquid assets? B, the full account balance is always counted as available assets? C, the account cannot be used for asset verification if penalties apply? Or D, the gross balance is counted, but the underwriter must note the penalty? The correct answer is A. Only the net amount available after penalties and taxes is considered as liquid assets. Why exam takers miss this? Many assume the full account balance is always counted, but only the accessible portion after penalties and taxes is considered liquid for underwriting. The presence of withdrawal penalties means only the net amount is eligible, not the gross balance. Employment and occupancy terminology. Which of the following best describes the difference between primary residence and owner-occupied as used in mortgage loan origination terminology? Is it A, both terms always refer to the borrower's main home? B, primary residence is for investment properties, while owner-occupied is for personal use? C, primary residence is always the main home, while owner-occupied can include second homes or vacation properties the borrower lives in? Or D, owner-occupied means the property is rented out, while primary residence means the borrower lives there? The correct answer is C. Primary residence is always the main home, while owner-occupied can include second homes or vacation properties the borrower lives in. Why this is hard? Many confuse primary residence and owner-occupied as interchangeable, but owner-occupied can include second homes or properties not used as the borrower's main dwelling. The correct answer highlights that primary residence is always the main home, while owner-occupied may refer to any property the borrower lives in, even if not their primary home. A borrower applies for a mortgage on a property they intend to use as a second home, but will occupy for several months each year. How should the occupancy status be classified on the loan application? Is it A, primary residence, B, second home, C, investment property, or D, non-owner occupied? The correct answer is B, second home. Why exam takers miss this? Many assume any property the borrower occupies is owner-occupied, but for mortgage purposes, second home is a distinct category from primary residence and has specific underwriting criteria. The correct answer is second home, not investment property or primary residence. If a borrower lists their employment as self-employed but provides only W-2 forms from a single company. Which employment classification should the loan originator use when completing the application? Is it A, self-employed, B, independent contractor, C, seasonal worker, or D, salaried employee? The correct answer is D, salaried employee. Why this trips people up? Many believe self-identification is sufficient, but employment classification must match documentation. W-2s indicate traditional employment, not self-employment, so the correct classification is salaried employee. Loan processing and underwriting terminology. Which of the following best distinguishes a conditional loan approval from a loan commitment in the mortgage underwriting process? Is it A, a conditional approval is always binding on the lender? B, a loan commitment is issued before any underwriting conditions are reviewed? C, a conditional approval requires additional documentation or actions before final approval, while a loan commitment is a final promise to fund the loan if no material changes occur? Or D, both terms refer to the same stage in the loan process? The correct answer is C. A conditional approval requires additional documentation or actions before final approval, while a loan commitment is a final promise to fund the loan if no material changes occur. Why this trips people up? Many confuse conditional approval with a full commitment, but a conditional approval means the loan is approved only if specific conditions are met, while a loan commitment is a binding promise to fund, assuming no material changes. Test takers often pick the answer that describes either term too broadly or too narrowly. In the context of mortgage loan processing, which document is most likely to trigger a request for a verification of deposit from the underwriter? Is it A, a recent pay stub, B, a bank statement showing a large unexplained deposit, C, a W-2 form from the previous year, or D, a copy of the purchase contract? The correct answer is B, a bank statement showing a large, unexplained deposit. Why exam takers miss this? Many assume the underwriter always requests verification of deposit, but it is typically triggered by discrepancies or large, unexplained deposits on the borrower's bank statement. Pay stubs and tax returns are less likely to prompt this, unless they reveal inconsistencies. An underwriter is reviewing a loan file and notices that the borrower's debt-to-income ratio is just below the program maximum, but the borrower also has significant non-taxable income. Which underwriting adjustment is most appropriate in this scenario? Is it A, apply a gross-up factor to the non-taxable income before recalculating the debt-to-income ratio? B, exclude the non-taxable income from qualifying income calculations? C, require the borrower to pay down debt to lower the ratio? Or D, disqualify the borrower due to the high debt-to-income ratio? The correct answer is A, apply a gross-up factor to the non-taxable income before recalculating the debt-to-income ratio. Why this is hard? Many overlook that non-taxable income can be grossed up, improving qualifying ratios. Test takers often miss this subtlety and choose answers that ignore the special treatment of non-taxable income in underwriting. Rate lock and redisclosure terminology. A borrower receives a revised loan estimate after a rate lock extension due to a delay caused by the borrower, but the lender does not provide the revised estimate until 5 business days after the extension. Which regulatory requirement has the lender failed to meet regarding redisclosure timing? Is it A, the lender failed to provide a closing disclosure within 3 business days, B, the lender failed to provide a revised loan estimate within 1 business day, C, the lender failed to provide a revised loan estimate within 3 business days, or D, the lender failed to provide a revised loan estimate within 7 calendar days? The correct answer is C, the lender failed to provide a revised loan estimate within 3 business days. Why this trips people up? Many confuse the timing for redisclosure with the general loan estimate delivery rules. The correct answer hinges on the requirement that a revised loan estimate must be provided within 3 business days of the event triggering the change, not 5. The other options reflect common timing misconceptions. Which of the following best describes the impact of a rate lock expiration on the need for redisclosure under the TILA RESPA Integrated Disclosure (TRID) rule? Is it A, redisclosure is always required when a rate lock expires regardless of changes to terms? B, redisclosure is required only if the expiration results in a change to points or lender credits? Redisclosure is never required after a rate lock expires. Or D, redisclosure is required only if the borrower requests a new rate lock. The correct answer is B. Redisclosure is required only if the expiration results in a change to points or lender credits. Why exam takers miss this? Many assume redisclosure is always required after a rate lock expires, but under TRID, redisclosure is only triggered if the expiration causes a change in points or lender credits. The other options reflect overgeneralizations or misunderstandings about when redisclosure is mandatory. If a lender issues a revised loan estimate due to a rate lock after the initial loan estimate was provided, the fees that are permitted to increase beyond the original tolerance limits under TRID rules are the origination charges, discount points, and any other fees paid to a lender for services the lender controls. Is it A, only fees directly affected by the rate lock, such as points or lender credits? B, all fees disclosed on the loan estimate? C, no fees are permitted to increase beyond the original tolerance limits? Or D, only third-party fees not controlled by the lender? The correct answer is A, only fees directly affected by the rate lock, such as points or lender credits. Why this is hard? Many test takers incorrectly believe all fees can be reset after a rate lock, but only those fees directly affected by the rate lock, such as points or lender credits, may exceed original tolerance limits. The other options reflect overbroad or under-inclusive interpretations of the rule. Loan estimate and closing disclosure terminology. Which fee is required to be listed in the loan estimate but is not subject to a tolerance limitation unless it is paid to an affiliate of the lender? B, prepaid interest. C, owner's title insurance. Or D, recording fees. D, the correct answer is C, owner's title insurance. Why exam takers miss this? Many confuse which fees are subject to 0 or 10% tolerance. Title insurance is required to be disclosed, but if paid to a non-affiliate, it is not subject to a tolerance limit. If paid to an affiliate, it is subject to the 10% cumulative tolerance, which is a subtle but critical distinction. If a lender discovers a clerical error in the closing disclosure after consummation, which action is required under TRID rules? Is it A, no action is required if the error is not numerical? B, a corrected closing disclosure must be provided within 60 days. C, the loan must be reclosed with a new closing disclosure. Or D, a new loan estimate must be issued. The correct answer is B, a corrected closing disclosure must be provided within 60 days. Why this trips people up? Many assume all post-consummation errors require a corrected closing disclosure. Only errors that are numerical, clerical, or non-numeric clerical require a corrected disclosure, and it must be provided within 60 days. Not all errors require redisclosure, but clerical ones do. A borrower receives a revised loan estimate due to a valid change circumstance, but the closing disclosure is provided the next day. Which timing rule applies to the closing disclosure delivery? Is it A, the closing disclosure must be delivered at least 3 business days before consummation? B, the closing disclosure may be delivered immediately after the revised loan estimate? C, the closing disclosure must be delivered within 1 business day of the revised loan estimate. Or D. The closing disclosure replaces the revised loan estimate and can be delivered at any time. The correct answer is A. The closing disclosure must be delivered at least 3 business days before consummation. Why this is hard? Many confuse the timing requirements for revised loan estimates and closing disclosures. The closing disclosure must still be provided at least 3 business days before consummation, regardless of when a revised loan estimate is issued. Qualified mortgage and ability to repay terminology. Which of the following features would automatically disqualify a mortgage from being considered a qualified mortgage under the ability to repay rule? Is it A, a loan term of 30 years, B, interest-only payments, C, a fixed interest rate, or D, a fully amortizing payment schedule? The correct answer is B, interest-only payments. Why this is hard? Many confuse features that are discouraged with those that are outright prohibited. Interest-only payments are specifically barred for qualified mortgages, while other features may be allowed under certain conditions. Test takers often misapply the rule to features that are only restricted in some contexts. A lender is evaluating a borrower's ability to repay and includes income from a part-time job the borrower has held for 6 months. Which qualified mortgage requirement is most likely at risk if the lender relies on this income? Is it A, the loan's points and fees limit, B, the prohibition on negative amortization, C, the requirement to verify and document income, or D, the maximum loan term restriction? The correct answer is C, the requirement to verify and document income. Why this trips people up? Many assume any current income can be counted, but qualified mortgage rules require that income be reasonably expected to continue. 6 months is generally insufficient to establish stability, so the documentation and verification standard is at risk. A borrower applies for a mortgage with a debt-to-income ratio slightly above the standard qualified mortgage threshold, but the loan otherwise meets all other QM criteria. Which statement best describes the lender's options under current ability to repay rules? Is it A, the loan cannot be originated under any qualified mortgage definition, B, the lender must deny the loan due to the DTI ratio, C, the loan can only be originated as a non-QM loan, or D, the loan may still qualify as a QM if it meets alternative criteria established by the CFPB? The correct answer is D. The loan may still qualify as a QM if it meets alternative criteria established by the CFPB. Why exam takers miss this? Many believe the DTI cap is absolute, but recent rule changes allow for alternative QM definitions where DTI can exceed the standard threshold if the loan meets other criteria. Refinance transaction terminology. In a refinance transaction, which of the following best describes the difference between a rate and term refinance and a cash-out refinance? Is it A, a rate and term refinance always results in a lower monthly payment? B, a cash-out refinance cannot change the interest rate? C, a cash-out refinance allows the borrower to receive funds exceeding the current mortgage balance, while a rate and term refinance does not? Or D, both types require the borrower to pay mortgage insurance? The correct answer is C. A cash-out refinance allows the borrower to receive funds exceeding the current mortgage balance, while a rate and term refinance does not. Why this trips people up? Many confuse the two types because both can change the loan's interest rate and term, but only a cash-out refinance allows the borrower to receive funds above the existing mortgage balance. Rate and term refinances only adjust the rate or term, not the principal balance. Test takers often select answers that blur this distinction. Which statement most accurately reflects the right of rescission in a refinance transaction under Regulation Z? Is it A, the right of rescission applies to all refinance transactions regardless of property type? B, the right of rescission applies only to refinances of a primary residence when the borrower is replacing an existing loan? C, the right of rescission applies only if the refinance increases the loan amount? Or D, the right of rescission is waived if the borrower signs a written statement at closing? The correct answer is B. The right of rescission applies only to refinances of a primary residence when the borrower is replacing an existing loan. Why exam takers miss this? Many assume the right of rescission applies to all refinance transactions, but it does not apply to refinances of investment properties or to new loans used to purchase a home. The correct answer reflects the nuanced application of this rule, which is a common exam trap. A borrower refinances their mortgage to consolidate debt and receives cash at closing. Which term best describes this transaction, and what is a key regulatory implication? Is it A, rate and term refinance, standard disclosure requirements apply? B, streamline refinance, no new disclosures are required? C, home equity loan, only truth in lending disclosures are required? Or D, cash-out refinance, stricter loan-to-value and additional disclosure requirements apply? The correct answer is D, cash-out refinance, stricter loan-to-value and additional disclosure requirements apply. Why this is hard? Many confuse debt consolidation with standard refinances, but receiving cash at closing makes this a cash-out refinance, which triggers stricter loan-to-value and disclosure requirements. Test takers often overlook that the regulatory implications differ from a rate and term refinance. Non-traditional mortgage terminology. Which of the following best distinguishes an interest-only mortgage from a payment option ARM in terms of required minimum payments during the initial period? Is it A, both require at least the interest due to be paid each month? B, interest-only mortgages require the full interest payment, while payment option ARMs may allow for less than the interest due? C, payment option ARMs never allow for negative amortization, but interest-only mortgages do? Or D, both allow for principal reduction in the initial period if the borrower chooses? The correct answer is B. Interest-only mortgages require the full interest payment, while payment option ARMs may allow for less than the interest due. Why this trips people up? Both products allow for lower initial payments, but only the payment option ARM permits payments that may be less than the interest due, potentially resulting in negative amortization. Many confuse interest-only loans with payment option ARMs because both can have low payments, but the key is that interest-only loans require at least the full interest payment each month. A borrower selects a hybrid ARM with a fixed rate for 5 years, after which the rate adjusts annually. Which term most accurately describes this loan structure? Is it A, interest-only mortgage, B, payment option ARM, C, hybrid ARM, or D, balloon mortgage? The correct answer is C, hybrid ARM. Why exam takers miss this? Many confuse hybrid ARMs with other non-traditional products, especially when the fixed period is mentioned. The term hybrid ARM specifically refers to loans with an initial fixed rate followed by adjustable rates, not to be confused with interest-only or payment option ARMs, which may also have fixed periods, but are defined by payment structure. A borrower is offered a mortgage with a low introductory rate, flexible payment options including minimum payments that do not cover all interest due, and the possibility of the loan balance increasing over time. Which non-traditional mortgage term best applies to this product? Is it A, hybrid ARM, B, interest-only mortgage, C, balloon mortgage, or D, payment option ARM? The correct answer is D. Why this is hard? The scenario describes features that overlap with several non-traditional products, but only payment option ARMs combine flexible payments, negative amortization, and a low introductory rate. Many confuse this with interest-only or hybrid RMs, but those do not allow for minimum payments below interest due. Ethics. Mortgage fraud terminology and red flags. Which of the following best distinguishes occupancy fraud from income fraud in mortgage applications? Is it A, occupancy fraud involves overstating assets? B, income fraud is always committed by the borrower? C, occupancy fraud involves misrepresenting the intended use of the property? Or D, income fraud is less likely to trigger lender scrutiny than occupancy fraud? The correct answer is C. Occupancy fraud involves misrepresenting the intended use of the property. Why this trips people up? Occupancy fraud and income fraud are both forms of misrepresentation, but they differ in what is falsified. Many confuse the two because both involve lying on the application. The correct answer focuses on the misrepresentation of property use, not financial details, which is a subtle but important distinction. A borrower provides gift letter for down payment funds, but the funds are immediately returned to the donor after closing. Which mortgage fraud red flag does this scenario most closely illustrate? Is it A, income misrepresentation? B, undisclosed loan or non-arm's length transaction? C, appraisal inflation? Or D, occupancy misrepresentation? The correct answer is B, undisclosed loan or non-arm's length transaction. Why exam takers miss this? The scenario tests knowledge of layered fraud techniques. Many confuse this with simple asset misrepresentation, but the key is the circular movement of funds, which is a classic sign of a straw buyer or undisclosed loan, not just a documentation issue. If a loan file contains multiple recent credit inquiries and several new undisclosed debts, which mortgage fraud red flag is most directly implicated? Is it A, liabilities omission? B, employment misrepresentation? C, straw buyer scheme? Or D, silent second mortgage? The correct answer is A, liabilities omission. Why this is hard? Multiple inquiries and new debts can be mistaken for normal financial activity, but on a mortgage application, they are a classic sign of undisclosed liabilities, which can indicate intent to mislead the lender about the borrower's true financial position.
Did you get a different answer? Or maybe you have a question about the exam in general? Drop it in the comments below. We read and answer them personally.
Consumer protection terminology. Which of the following best distinguishes the concept of unfair practice from deceptive practice under consumer protection regulations? B, unfair practices can occur without misrepresentation, while deceptive practices require misleading or false statements. C, deceptive practices are always illegal, but unfair practices are not regulated. Or D, unfair practices only apply to advertising, while deceptive practices apply to all business conduct. The correct answer is B, unfair practices can occur without misrepresentation, while deceptive practices require misleading or false statements. Why this trips people up? Many confuse unfair and deceptive as interchangeable, but regulations define them differently. The correct answer highlights that unfair practices harm consumers even without deception, while deceptive practices involve misleading statements. A strong test taker might choose an answer that only partially captures this distinction. A lender advertises a loan with no hidden fees, but the contract includes a processing charge disclosed only in the fine print. Under consumer protection terminology, which term most precisely describes this conduct? Is it A, unfair practice? B, bait and switch scheme? C, deceptive practice? Or D, predatory lending? The correct answer is C, deceptive practice. Why exam takers miss this? Many confuse unfair with deceptive or think bait and switch applies. The key is that the main claim is contradicted by the fine print, making it a deceptive practice. Bait and switch would require a different pattern, and unfair does not require deception. Which of the following most accurately defines material fact in the context of consumer protection terminology? Is it A, a fact that would likely influence a reasonable consumer's decision to buy or not buy a product or service? B, any fact related to the product or service, regardless of its importance? C, a fact that is required by law to be disclosed, regardless of its impact on the consumer? Or D, a fact that is true, regardless of whether it affects the consumer's choice? The correct answer is A, a fact that would likely influence a reasonable consumer's decision to buy or not buy a product or service. Why this is hard? Many confuse material fact with any fact or with information that is merely interesting. The correct answer is about information that would influence a consumer's decision. Distractors may seem plausible, but are too broad or narrow. Ethical lending terminology and standards. Which of the following most accurately distinguishes between predatory lending and subprime lending under current ethical lending standards? Is it A, predatory lending and subprime lending are both defined by charging higher interest rates? B, subprime lending is always considered unethical, while predatory lending is not? C, predatory lending is characterized by abusive or deceptive practices, while subprime lending refers to lending to higher-risk borrowers without necessarily violating ethical standards? Or D, both terms are interchangeable under most regulatory definitions? The correct answer is C. Predatory lending is characterized by abusive or deceptive practices, while subprime lending refers to lending to higher-risk borrowers without necessarily violating ethical standards. Why this trips people up? Many confuse subprime lending with predatory lending, but subprime refers to higher-risk borrowers, while predatory lending involves unethical practices regardless of borrower risk. The correct answer highlights that subprime lending is not inherently unethical, whereas predatory lending is defined by its abusive nature. Some may incorrectly select answers that conflate risk level with ethicality. Under ethical lending standards, which scenario best illustrates a violation of the principle of suitability rather than disclosure? Is it A, a lender provides all required disclosures but fails to explain complex terms? B, a lender steers a low-risk borrower into a high-cost loan despite more appropriate options being available? C, a lender omits the annual percentage rate from the loan documentation? Or D, a lender provides a loan estimate after the required time frame? The correct answer is B. A lender steers a low-risk borrower into a high-cost loan despite more appropriate options being available. Why exam takers miss this? Many confuse suitability with disclosure, but suitability is about matching products to borrower needs, not just providing information. The correct answer involves offering an unsuitable product, while others focus on information provided or omitted. A lender offers a loan with terms that are technically legal but are structured to maximize fees and penalties in ways that are not transparent to the borrower. Under ethical lending standards, which term best describes this practice? Is it A, predatory lending, B, usury, non-compliance, or D, redlining? The correct answer is A, predatory lending. Why this is hard? The scenario describes legal but unethical behavior, which is the hallmark of predatory lending. Many confuse this with usury or non-compliance, but the key is the exploitation and lack of transparency, not just legality or interest rate. Predatory lending terminology. Which of the following most accurately distinguishes steering from targeting in the context of predatory lending practices? Is it A, steering is marketing to vulnerable communities, while targeting is directing borrowers to specific loan products. B. Both terms mean the same thing in predatory lending contexts. C. Steering is directing borrowers to specific loan products, while targeting is identifying vulnerable populations for marketing. Or D. Targeting is illegal under all circumstances, while steering is not. The correct answer is C. Steering is directing borrowers to specific loan products, while targeting is identifying vulnerable populations for marketing. Why this trips people up? Many confuse steering and targeting because both involve lender influence over borrower choices. However, steering is the act of directing borrowers to specific, often unfavorable loan products, while targeting refers to identifying and marketing to vulnerable groups. The distinction is subtle but critical for exam accuracy. A lender charges a borrower excessive fees not disclosed in the initial loan estimate and structures the loan to make refinancing likely and costly. Which predatory lending term best describes this combination of practices? Is it A. Packing, B. Loan flipping, C. Redlining, or D. Equity stripping? The correct answer is B. Loan flipping. Why exam takers miss this? The scenario blends multiple abusive tactics, tempting test takers to choose packing or flipping. However, loan flipping specifically refers to repeated, unnecessary refinancing for lender profit, which is the core abuse here, even though excessive fees are present. If a lender knowingly makes a loan to a borrower who clearly lacks the ability to repay, relying on the value of the collateral rather than the borrower's income, which predatory lending term most precisely applies? Is it A. Asset-based lending, B. Equity stripping, C. Reverse redlining, or D. Balloon payment? The correct answer is A. Asset-based lending. Why this is hard? Many confuse asset-based lending with equity stripping. While both involve collateral, asset-based lending specifically refers to loans made without regard to repayment ability, relying solely on collateral, which is the scenario described. Misrepresentation and disclosure terminology. Which of the following best distinguishes a material misrepresentation from a non-material misrepresentation in the context of required disclosures to clients? Is it A. A material misrepresentation is always intentional, B. A non-material misrepresentation is always truthful, C. A material misrepresentation is one that would likely affect a reasonable person's decision, or D. A non-material misrepresentation is one that is corrected before discovery? The correct answer is C. A material misrepresentation is one that would likely affect a reasonable person's decision. Why exam takers miss this? Many confuse material with intentional or fraudulent. The key is that materiality depends on whether the information would influence a reasonable person's decision, not the intent or the truthfulness alone. Some options seem plausible because they mention intent or accuracy, but only the correct answer focuses on the impact on client decisions. A licensee learns of a minor defect in a property that is not required by law to be disclosed and is unlikely to affect the buyer's decision, but the seller instructs the licensee not to mention it. What is the licensee's best course of action under standard misrepresentation and disclosure rules? Is it A. Disclose the defect regardless of the seller's wishes, B. Follow the seller's instruction, since the defect is not material and not legally required to be disclosed, C. Refuse to represent the seller due to the non-disclosure, or D. Disclose the defect only if directly asked by the buyer? The correct answer is B. Follow the seller's instruction, since the defect is not material and not legally required to be disclosed. Why this trips people up? Many assume all defects must be disclosed, but only material defects require disclosure. The correct answer recognizes the distinction between legal requirements and ethical best practices, while other options confuse legal mandates with ethical considerations. An agent advertises a property as recently renovated, but only the kitchen was updated, while the rest of the house remains in original condition. Which type of misrepresentation, if any, has occurred under standard disclosure terminology? Is it A, misrepresentation, B, puffery, C, no misrepresentation, since the kitchen was renovated, or D, fraud? The correct answer is A, misrepresentation. Why this is hard? Many confuse puffery with misrepresentation. The correct answer identifies this as a misleading statement of fact, misrepresentation, not mere opinion or exaggeration, because recently renovated implies more than just the kitchen. Conflicts of interest terminology. Which of the following best distinguishes a material conflict of interest from a potential conflict of interest under standard professional ethics terminology? Is it A, a material conflict is always financial in nature? B, a potential conflict must be disclosed immediately, while a material conflict does not require disclosure until it becomes actual? C, a material conflict is one that a reasonable person would expect to influence professional judgment, while a potential conflict is a situation that could develop into a material conflict? Or D, both terms refer to the same concept and can be used interchangeably in disclosures? The correct answer is C. A material conflict is one that a reasonable person would expect to influence professional judgment, while a potential conflict is a situation that could develop into a material conflict. Why exam takers miss this? Many confuse material with potential, assuming both require the same level of disclosure. The key distinction is that a material conflict is one that a reasonable person would expect to influence professional judgment, while a potential conflict is a situation that could develop into a material conflict but has not yet done so. An investment advisor's spouse owns a significant stake in a company the advisor is considering recommending to clients, but the advisor is unaware of this ownership. Under standard conflict of interest terminology, how is this situation best classified? Is it A, it is an actual conflict of interest? B, it is a potential conflict of interest? C, it is a material conflict of interest? Or D, it is not a conflict of interest in any sense? The correct answer is B, it is a potential conflict of interest. Why this trips people up? Many assume any undisclosed relationship is a conflict, but actual conflicts require knowledge and the ability to act. Here, the advisor's lack of awareness means it is a potential conflict, not an actual or material conflict, though it could become one if discovered. A professional receives a gift of nominal value from a client during the holiday season and later refers the client's business to a family member's firm without disclosing the relationship. Which term best describes the ethical issue present? Is it A, receipt of an improper gift? B, potential conflict of interest due to the gift? C, no conflict of interest, as the gift was nominal and customary? Or D, material conflict of interest due to undisclosed referral to a family member? The correct answer is D, material conflict of interest due to undisclosed referral to a family member. Why this is hard? Many focus on the gift, but the real conflict arises from the undisclosed referral to a family member. The scenario tests the difference between a minor gratuity and a material conflict requiring disclosure due to personal relationships. Advertising and marketing compliance terminology. Which of the following best distinguishes puffery from deceptive advertising under most regulatory definitions in advertising and marketing compliance terminology? Is it A, puffery consists of subjective, unverifiable claims, while deceptive advertising involves objectively false or misleading statements? B, puffery is illegal in all advertising, while deceptive advertising is only illegal if it causes financial harm? C, Deceptive advertising always involves intent to mislead, while puffery does not require intent. Or D. Puffery applies only to product pricing, while deceptive advertising applies to product quality. The correct answer is A. Puffery consists of subjective, unverifiable claims, while deceptive advertising involves objectively false or misleading statements. Why this is hard? Many confuse puffery with deception because both involve exaggerated claims. However, puffery is a subjective statement that cannot be objectively verified, while deceptive advertising involves a false or misleading claim that can mislead a reasonable consumer. The trap is thinking all exaggeration is deception, but only objectively false or misleading statements cross the line. A firm advertises a product as clinically proven to work, but the supporting study is outdated and not peer-reviewed. Under advertising compliance terminology, which term best describes this practice? Is it A. Bait and switch, B. Puffery, C. Unsubstantiated claim, or D. Endorsement violation? The correct answer is C. Unsubstantiated claim. Why this trips people up? Many confuse substantiation with mere disclosure, or assume any study suffices. The key is that compliance requires a reasonable basis, typically current and reliable evidence. Using outdated or non-peer-reviewed studies fails the substantiation requirement, even if some evidence exists. An agent includes a client testimonial in a marketing brochure without disclosing that the client received a discount for providing the endorsement. Under advertising compliance terminology, what is the primary violation? Is it A. Failure to substantiate the testimonial, B. Failure to disclose a material connection, C. Use of misleading comparative advertising, or D. Improper use of a celebrity endorsement? The correct answer is B. Failure to disclose a material connection. Why exam takers miss this? Many focus on the truthfulness of the testimonial, but the main issue is the undisclosed material connection. Compliance rules require disclosure of any compensation or incentive that could affect the endorsement's credibility, not just the accuracy of the statement. Record retention and confidentiality terminology. Which of the following best distinguishes between the concepts of record retention and confidentiality in the context of professional ethics for client files? Is it A. Both record retention and confidentiality require client consent for any action taken with records? B. Record retention refers to the destruction of records, while confidentiality refers to the storage of records? C. Record retention governs how long records must be kept, while confidentiality governs who may access the information within those records? Or D. Confidentiality applies only during the retention period of records, not after destruction? The correct answer is C. Record retention governs how long records must be kept, while confidentiality governs who may access the information within those records. Why this trips people up? Many confuse retention requirements with confidentiality obligations, assuming they are governed by the same rules. The correct answer highlights that retention is about how long records are kept, while confidentiality is about who may access the information, regardless of retention period. A strong test taker might choose an answer that conflates the two or focuses only on one aspect. A professional is subpoenaed to produce client records that are past the mandatory retention period, but contain confidential information. Which ethical principle should primarily guide the professional's response? Is it A. The professional should destroy the records immediately, as retention is no longer required? B. The professional must maintain client confidentiality unless a valid legal exception, such as a court order, compels disclosure? C. The professional should disclose the records since the retention period has expired and there is a subpoena? Or D. The professional may disclose the records only if the client provides written consent, regardless of the subpoena? The correct answer is B. the professional must maintain client confidentiality unless a valid legal exception, such as a court order, compels disclosure. Why exam takers miss this? Many assume that once the retention period lapses, confidentiality no longer applies, or that legal demands override all ethical duties. The correct answer is that confidentiality remains paramount unless a valid legal exception applies. A strong test taker might incorrectly prioritize retention rules or misinterpret the effect of the subpoena. Uniform state content, state licensing terminology, and NMLS definitions. Which of the following best describes the difference between a state-specific license endorsement and a federal registration under the NMLS system? Is it A, both are required for all mortgage loan originators nationwide? B, a state-specific endorsement is optional if you have federal registration? C, a state-specific license endorsement is granted by a state agency, while federal registration is managed by federal regulators through NMLS. Or D, federal registration automatically grants all necessary state endorsements. The correct answer is C. A state-specific license endorsement is granted by a state agency, while federal registration is managed by federal regulators through NMLS. Why this trips people up? Many confuse federal registration with state licensing, but only state agencies can grant or require endorsements for specific activities within their jurisdiction. Federal registration through NMLS is required for federally regulated institutions, but does not substitute for state licensing or endorsements. If a mortgage loan originator's license status in NMLS is listed as inactive, what does this most precisely indicate about their legal authority to originate loans? Is it A, the license is expired and must be renewed before originating loans? B, the license is valid but the MLO cannot originate loans until sponsored by an employer? The license has been permanently revoked by the state regulator? Or D, the MLO may originate loans only under federal registration? The correct answer is B, the license is valid, but the MLO cannot originate loans until sponsored by an employer. Why exam takers miss this? Many assume inactive means the license is expired or revoked, but in NMLS terminology, inactive specifically means the license is valid but not sponsored by an employer, so the MLO cannot originate loans until sponsorship is restored. A mortgage company is licensed in multiple states and employs loan originators who are registered in NMLS but not state licensed. Under which condition can these originators lawfully originate loans? Is it A, they are employed by a federally regulated depository institution? B, they are supervised by a state-licensed mortgage company? C, they have completed pre-licensure education but not passed the state exam? Or D, they have applied for state licensure but are awaiting approval? The correct answer is A, they are employed by a federally regulated depository institution. Why this is hard? The distinction between registration and licensing is subtle. Only originators employed by federally regulated institutions, like banks, may originate loans with just NMLS registration. Others must be state licensed. Many confuse multi-state company status with federal regulation. State regulatory authority terminology. Which of the following best describes the primary distinction between a state regulatory authority and the nationwide multi-state licensing system, NMLS, in the context of mortgage licensing? Is it A, state regulatory authorities only provide administrative support? B, the NMLS has the power to issue and revoke licenses? C, state regulatory authorities enforce licensing laws, while the NMLS is a centralized record system? Or D, both state authorities and the NMLS have equal regulatory authority? The correct answer is C. State regulatory authorities enforce licensing laws, while the NMLS is a centralized record system. Why this trips people up? Many confuse the NMLS with a regulatory authority, but it is actually a system for processing applications and maintaining records. State regulatory authorities have the legal power to enforce laws and issue licenses, while the NMLS does not regulate or enforce. If a mortgage loan originator's license is suspended by a state regulatory authority, which entity is responsible for updating the license status in the NMLS, and what is the legal effect of that update? Is it A, the NMLS updates the status and this action legally suspends the license? B, the state regulatory authority updates the status and the legal suspension is effective upon the state's action? C, both the state authority and the NMLS must act for the suspension to be effective. Or D, the NMLS notifies the state authority, which then updates the legal status. The correct answer is B, the state regulatory authority updates the status and the legal suspension is effective upon the state's action. Why exam takers miss this? Many assume the NMLS has regulatory power, but only the state authority can change legal status. The NMLS reflects updates made by the state, but the legal effect comes from the state's action, not the NMLS record itself. A mortgage company operates in multiple states and receives a regulatory inquiry from one state's authority regarding alleged violations. Which authority has the power to enforce penalties, and how does this relate to the company's NMLS record? Is it A, only the state regulatory authority where the violation occurred can enforce penalties, and the NMLS will reflect any disciplinary action? B, any state where the company is licensed can enforce penalties for violations in another state? C, the NMLS can directly impose penalties on behalf of state authorities? Or D, penalties must be enforced by a federal regulator and then reported to the NMLS? The correct answer is A, only the state regulatory authority where the violation occurred can enforce penalties and the NMLS will reflect any disciplinary action. Why this is hard? Test takers often think the NMLS or other states can enforce penalties, but only the state authority where the violation occurred has enforcement power. The NMLS will reflect disciplinary actions, but it does not impose them. Mortgage broker and lender terminology. Which of the following best distinguishes a mortgage broker from a mortgage lender under the Uniform State Content definitions? Is it A, a mortgage broker originates and funds loans directly? B, a mortgage lender only arranges loans between borrowers and investors? C, a mortgage broker arranges loans but does not provide the loan funds? Or D, a mortgage lender cannot originate loans, only service them? The correct answer is C, a mortgage broker arranges loans but does not provide the loan funds. Why this trips people up? Many confuse the roles due to overlapping activities. The key distinction is that a mortgage broker arranges loans but does not fund them, while a lender provides the actual funds. Some believe brokers can fund loans, but this is incorrect under standard definitions. In which scenario would a company be classified as a mortgage lender rather than a mortgage broker, according to Uniform State Content terminology? Is it A, the company collects borrower applications and submits them to multiple funding sources? B, the company provides the funds at closing from its own capital? C, the company advises borrowers on loan options but does not provide funds? Or D, the company services loans after they are closed by another entity? The correct answer is B, the company provides the funds at closing from its own capital. Why exam takers miss this? The distinction hinges on who provides the funds. Many assume that negotiating loan terms makes a company a lender, but only the entity providing the funds is the lender. Arranging, negotiating, or advising does not make one a lender unless they fund the loan. A licensed entity both arranges residential mortgage loans for clients and, on occasion, funds loans using its own capital. Under Uniform State Content terminology, how is this entity classified when it funds a loan from its own resources? Is it A, it is acting as a mortgage lender? B, it is acting as a mortgage broker? C, it is acting as a loan servicer only? Or D, it is acting as a correspondent lender exclusively? The correct answer is A. It is acting as a mortgage lender. Why this is hard? Entities can act as both broker and lender, but their classification depends on the specific transaction. When funding with its own capital, the entity is acting as a lender, not a broker. Many confuse the entity's general license with its role in a given transaction. Surety bond and net worth terminology. Which of the following best distinguishes a surety bond requirement from a net worth requirement for a mortgage license applicant under the Uniform State Content Standards? Is it A, both are forms of insurance protecting the applicant from business losses? B, both are required to be maintained at all times during licensure? C, a surety bond protects consumers and the state, while net worth demonstrates the applicant's financial stability? Or D, a net worth requirement can be satisfied by purchasing a surety bond? The correct answer is C. A surety bond protects consumers and the state, while net worth demonstrates the applicant's financial stability. Why exam takers miss this? Many confuse surety bond and net worth requirements as interchangeable forms of financial responsibility. The key distinction is that a surety bond protects consumers and the state from applicant misconduct, while net worth demonstrates the applicant's own financial stability. Distractors often mix up who or what is protected by each requirement. A mortgage company's net worth falls below the minimum required by state law, but its surety bond remains in full effect and up to date. Which of the following best describes the company's compliance status under Uniform State Content rules? Is it A, the company is fully compliant as long as the surety bond is maintained? B, the company is out of compliance due to insufficient net worth regardless of the surety bond status? C, the company may continue operating until the surety bond expires? Or D, the company can offset the net worth deficiency by increasing the surety bond amount? The correct answer is B. The company is out of compliance due to insufficient net worth, regardless of the surety bond status. Why this trips people up? Many assume that maintaining a surety bond is sufficient for compliance, but Uniform State Content rules treat net worth and surety bond requirements as separate and independent. A deficiency in net worth is a violation even if the surety bond is current. Distractors reflect common misapplications of this distinction. State examination and enforcement terminology. Which of the following best describes the difference between an administrative order and a cease and desist order issued by a state securities regulator during an enforcement action? Is it A, both orders require a prior hearing before they can be issued? B, a cease and desist order may be issued without a prior hearing, while an administrative order typically follows a hearing? C, administrative orders are only used for criminal violations, while cease and desist orders are for civil matters? Or D, cease and desist orders are always temporary, while administrative orders are always permanent? The correct answer is B. A cease and desist order may be issued without a prior hearing, while an administrative order typically follows a hearing. Why this trips people up? Many confuse the scope and immediacy of these orders. An administrative order is a formal finding or penalty after a hearing, while a cease and desist order can be issued immediately to halt suspected violations before a hearing. Test takers often select the option that confuses timing or procedural requirements. Under the Uniform Securities Act, which statement most accurately reflects the authority of a state administrator to subpoena witnesses and documents during an investigation? Is it A, the administrator may subpoena only in-state witnesses and documents? B, the administrator must obtain a court order before issuing any subpoena? C, The administrator may subpoena witnesses and documents from inside or outside the state, if relevant to the investigation. Or D. Subpoenas may be issued only after a formal complaint has been filed. The correct answer is C. The administrator may subpoena witnesses and documents from inside or outside the state if relevant to the investigation. Why exam takers miss this? Many assume the administrator's authority is limited to in-state matters. In reality, the administrator can subpoena witnesses and documents from inside or outside the state if relevant to the investigation, a subtle but crucial distinction often overlooked. A state administrator discovers evidence of a securities violation and immediately issues a summary order suspending a registration. Which statement best describes the registrant's rights under the Uniform Securities Act? Is it A. The registrant is entitled to a prompt hearing if requested, but the order remains in effect until the hearing or further action by the administrator? B. The summary order is invalid until a hearing is held and a final decision is issued? C. The administrator must notify the registrant at least 10 days before issuing a summary order? Or D. The registrant may appeal the order only after the administrator has completed the investigation? The correct answer is A. The registrant is entitled to a prompt hearing if requested, but the order remains in effect until the hearing or further action by the administrator. Why this is hard? Many confuse summary orders with final actions. The registrant has the right to a prompt hearing upon request, but the order remains effective until the hearing occurs or the administrator lifts it. Test takers often mistakenly believe the order is invalid until a hearing is held. Continuing education and license maintenance terminology. Which of the following best describes the difference between continuing education and license renewal as used in uniform state content terminology for mortgage loan originators? Is it A. Continuing education and license renewal are interchangeable terms? B. License renewal must be completed before any continuing education is reported? C. Continuing education is a requirement that must be satisfied before a license can be renewed? Or D. License renewal automatically satisfies all continuing education requirements? The correct answer is C. Continuing education is a requirement that must be satisfied before a license can be renewed. Why this trips people up? Many confuse continuing education with the act of renewing a license, but continuing education is a prerequisite activity, not the renewal itself. The correct answer distinguishes the requirement, education, from the administrative process, renewal, while distractors blur or reverse this relationship. A mortgage loan originator completes all required continuing education hours but submits the license renewal application after the deadline. Under uniform state content rules, what is the most likely consequence? Is it A. The license remains active because education was completed on time? B. The license will lapse or become inactive until the renewal is properly submitted and any late fees are paid? C. The license is permanently revoked and cannot be reinstated? Or D. No action is needed as long as continuing education is completed within the calendar year? The correct answer is B. The license will lapse or become inactive until the renewal is properly submitted and any late fees are paid. Why exam takers miss this? Many assume that completing education is sufficient for timely renewal, but missing the renewal deadline triggers additional consequences regardless of education status. The best answer highlights the administrative penalty, while distractors confuse education with renewal or overstate the penalty. Prohibited conduct and disciplinary action terminology. A mortgage loan originator, MLO, accepts a loan application and before submitting it to a lender, alters the applicant's stated income to improve approval chances without the applicant's knowledge. Which specific type of prohibited conduct does this action represent under the Uniform State Content Rules? Is it A. Misrepresentation of material facts? B. Fraudulent inducement. C. Falsification of documents. Or D. Unlicensed activity. The correct answer is C. Falsification of documents. Why this trips people up? Many confuse falsifying information with general misrepresentation or assume it's only prohibited if the applicant is aware. The key distinction is that altering information without consent is specifically classified as falsification of documents, not just misrepresentation or fraud. Test takers often overlook the requirement that even well-intentioned changes are strictly prohibited. Which of the following disciplinary actions may a state regulatory authority impose for a single instance of prohibited conduct under the Uniform State Content, even if no financial harm occurred? Is it A. Only a written warning? B. License suspension or revocation? C. Mandatory restitution to the consumer? Or D. No action unless a pattern of misconduct is established? The correct answer is B. License suspension or revocation. Why exam takers miss this? Many assume that disciplinary actions require proof of consumer harm or financial loss. However, state authorities can impose penalties, including license suspension or revocation, for a single violation regardless of harm. The trap is thinking consequences are only tied to actual damages. Under Uniform State Content rules, which of the following is not considered prohibited conduct for a licensee, even though it may appear unethical to some? Is it A. Failing to disclose a material fact to a lender? B. Accepting compensation from both borrower and lender without disclosure? C. Submitting false documents to a regulator? Or D. Refusing to work with a client who requests an illegal act? The correct answer is D. Refusing to work with a client who requests an illegal act. Why this is hard? The distinction between unethical and prohibited conduct is subtle. Many assume all questionable behavior is prohibited, but only actions explicitly listed in the rules are violations. The correct answer is a practice that, while possibly unprofessional, is not specifically banned under the Uniform State Content.
Thanks for watching. If you found this exam review helpful, be sure to subscribe for more real-world practice and topic-focused study videos. And visit birdsey.ai to start your free trial of Birdsey, your AI-powered study partner.